why do I love the S&P 500? Let me give you a few examples of why. In order to be incorporated into the S&P 500, the company has to have had positive earnings over the most recent quarter and positive average earnings over the last 4 quarters. It rebalances itself, so it gets rid of all the losers effectively. So anything that's losing money and it's not having a positive earning, it gets rebalanced quarterly. So that's going to be in March, June, September, and December of most years. They're all US listed companies. So you don't have ETFs or ADR or ADS. Basically, it's listed on the New York Stock Exchange, the NASDAQ, or the CBOE. Why is this a good thing? From what I've seen, certain regions of the world, people will lie more often about earnings, and by being under the scrutiny of the US government, it gives you a little bit more security in that it's actually going under the US Security and Exchange Commissions. So effectively, they're being investigated. If they lie about something, people go to jail. Basically, they don't lie as much, and if they do, they get caught. The company has to have high liquidity, meaning that over 50% of the shares are available to trade. They're not locked up by a single entity that can actually control the market. You want to have over 250,000 shares traded per month, each and every month over the last 6 months. So that means there's a lot of people that are buying and selling. You don't have just one person controlling everything, so they can't control the prices easily. So each of the companies, currently the market cap at minimum is about $18 billion. If you look at the S&P 500, it makes up about 80% of the US market. So what do I mean by market cap? So it rebalances by the market cap. Market cap is effectively, if you take the dollars per share and multiply by the number of shares, that's where you're getting $18 billion for each of these companies or greater. So if you're trying to figure out the market cap, let's say you have $10 per share times 100 shares, that means the market cap would be $1,000, just as an easy math example. The S&P 500 index, it gets reweighted with the company weighting. So how's that? So you take the company market cap, which is calculated here, and you divide by the total market cap of the entire S&P 500, and that's how you get a percentage of how much of each company there should be. So you should probably be familiar with a lot of the companies on here, being that they make up about 80% of the US market. So they have things like Apple, Microsoft, Amazon, Nvidia. These are Alphabet A and Alphabet Class C stock, which own Google, and Google owns YouTube, which you're watching this on. Tesla, you have Meta, which is Facebook, Berkshire Hathaway, ExxonMobil. It's like 20 to 30% of the S&P 500 is made up by the names you see here. It's a little top heavy, but as other companies do well, such as Nvidia just joined that top 10 list, Tesla joined that top 10 list as well. Other things, as they do well, will move to the top, and things that don't do well will fall to the bottom and eventually get kicked off of the S&P 500 index. The other reason I really like this is basically you're taking all the winners. So whatever's outperforming the rest of the market, effectively, that's what you get to keep. So the biggest companies are what go onto the list. Okay, you might not have explosive returns, but it tends to be a little bit more stable. The S&P 500 has returned 10.7% average rate of return per year over the past 30 years. Now, understand that all investments carry risk, and past performance does not guarantee future performance, and investments may lose value. 10.7% average rate of return over the last 30 years. Okay, there's a couple of years it goes down 20 or 30%, and there's other years it goes up 20, 30%. But overall, it averages out to about 10.7%. And of that 10.7%, 1.3% of that is represented by your dividend. If you're looking to get exposure into the S&P 500, the easiest ones are SPY, VOO, these are ETFs. A mutual fund that works well is FXAIX. Basically, they track the S&P 500, they keep your expenses low. Your expenses matter because the more you pay to expenses, that it compounds over your lifetime of investing, and over the course of, say, 30 or 40 years, those can become very significant. Each of these is less than 0.1%. Thank you for watching. If you're interested in making more money, how to invest, and how to save money on taxes, those are a lot of topics that I cover on this channel. I'd like to help you make more money and provide for your family. Have a great day.